Have you ever wondered how the ultra-wealthy manage their money differently than everyone else? Or why some financial practices make headlines while others are perfectly legal? Let's dive into the fascinating world of financial management that walks the fine line between clever and criminal. Money laundering is a serious financial crime that involves disguising illegally obtained funds as legitimate income. Rather than providing instructions on illegal activities, I'd like to focus on legal financial management practices that sometimes get confused with money laundering and explain the important distinctions between legal and illegal financial activities. Legal financial management versus illegal money laundering. Picture this: two business owners both want to pay less tax. One hires an accountant to find every legal deduction, business expenses, retirement contributions, and investment strategies allowed by tax law. The other creates fake companies that exist only on paper to hide income. From the outside, both might look like they're working the system, but one is smart financial planning, while the other is criminal money laundering. Money laundering involves sneaking dirty money into the financial system, bouncing it through complex transactions to hide its source, and then making it appear as legitimate income. Legal financial planning, however, is about managing money you earned honestly in ways that maximize growth and minimize taxes, all while following reporting requirements and tax laws. Legal ways to manage money and minimize tax burden. There are numerous legal approaches to managing money efficiently. Tax avoidance, using legal methods to minimize tax liability, differs fundamentally from tax evasion, illegally hiding income or providing false information. Legal tax strategies include maximizing retirement account contributions, harvesting investment losses to offset gains, timing income recognition and deductions, and using legitimate business deductions according to tax code provisions. Before continue, if you're enjoying this video, please like, share, and subscribe. Now let's dive back in. Business structures and asset protection. Creating the right business structure is like building a legal fence around your personal assets. An LLC can shield your personal savings and home if your business gets sued. S-corporations can help reduce self-employment taxes for many business owners by allowing them to take part of their income as dividends. Offshore banking and international finance. While often associated with money laundering, legitimate offshore banking has legal purposes, including currency diversification, legal tax planning for international businesses, asset protection in politically stable jurisdictions, and investment diversification. The key difference is transparency and compliance with reporting requirements like the Foreign Account Tax Compliance Act, FATCA, and Foreign Bank Account Report, FBAR. The Pandora Papers and financial transparency. The Pandora Papers are the latest in a long line of leaked documents, following the Panama Papers, Paradise Papers, and others that have exposed questionable financial practices of wealthy individuals, politicians, and corporations worldwide. Released in 2021, these documents from 14 offshore service providers revealed how the global elite use complex offshore structures to shield wealth, avoid taxes, and in some cases, hide illicit funds. The investigation implicated over 330 politicians and public officials from 90 countries, exposing how these individuals used shell companies, trusts, and other financial vehicles in tax havens to conceal assets worth billions. What makes the Pandora Papers particularly significant is their unprecedented scope, revealing not just traditional offshore havens like the Cayman Islands and British Virgin Islands, but also the growing role of U.S. states like South Dakota and Nevada in offering financial secrecy. While many arrangements documented in these papers technically adhere to legal requirements, they highlight the ethical questions surrounding extreme wealth concentration and the separate financial system that exists for the ultra-wealthy. These revelations have intensified calls for greater financial transparency, automatic information exchange between countries, and beneficial ownership registries to combat the systemic issues of tax avoidance and potential money laundering. Real estate investments. Property investments come with amazing tax perks. When you sell one property and buy another investment property, called a 1031 exchange, you can postpone paying taxes on your profits. You can also deduct the theoretical wearing out of buildings, depreciation, even when the property is actually increasing in value. For example, a small apartment building that generates $50,000 in yearly income might have $30,000 in deductible expenses like mortgage interest, property taxes, insurance, and depreciation, meaning the owner might only pay taxes on $20,000 or less. Cash businesses and proper accounting. Cash-intensive businesses must maintain proper accounting and reporting to remain legal. This includes using point-of-sale systems with thorough documentation, separating business and personal accounts, employing professional bookkeeping and accounting services, and making regular tax filings with complete transparency about income and expenses. Charitable giving and foundations. Philanthropic activities offer legitimate tax benefits through vehicles such as charitable remainder trusts, donor-advised funds, family foundations, and charitable gift annuities. These approaches allow for tax deductions while supporting charitable causes, but require proper documentation and compliance with nonprofit regulations. The legal line and compliance requirements. Legal financial management requires compliance with various reporting obligations, including income tax filing requirements, currency transaction reports, CTRs, for transactions over $10,000, suspicious activity reports, SARs, filed by financial institutions, and foreign account and asset reporting. Understanding and meeting these requirements is essential for legal financial management. Know your customer, KYC, and anti-money laundering, AML, compliance. Financial institutions implement KYC and AML protocols to prevent money laundering. Legitimate customers should expect and comply with identity verification requirements, source of funds documentation requests, transaction monitoring, and business purpose verification. These procedures protect the financial system and ensure compliance with regulations. Red flags and activities to avoid. To ensure you stay on the legal side of financial management, avoid structuring transactions to evade reporting requirements, using third parties to hide ownership, commingling personal and business funds, creating false documentation or invoices, failing to report taxable income, and using multiple shell companies without legitimate business purpose. Professional guidance is essential. Complex financial planning requires professional guidance from certified public accountants, CPAs, tax attorneys, financial advisors, and compliance specialists. These professionals help ensure financial strategies remain within legal boundaries while maximizing efficiency and can provide documentation of their advice as evidence of good faith compliance efforts. The consequences of crossing the line. The penalties for actual money laundering are severe and can include federal prison sentences, substantial fines and penalties, asset forfeiture, permanent damage to financial reputation, and professional license revocation. The risk of these consequences far outweighs any potential short-term financial gain from illegal activities. Ethical wealth building. Legitimate wealth building takes time and relies on consistent saving and investing, business building through value creation, maximizing legally available tax strategies, financial education and planning, and maintaining a long-term perspective. While perhaps slower than illegal shortcuts, ethical wealth building provides sustainable financial security without legal risk. The distinction between legal financial management and money laundering lies in transparency, reporting compliance, and the source of funds. Building wealth through legal means may take longer than illegal shortcuts, but provides sustainable financial security without the risk of severe legal consequences. Always consult with qualified legal and financial professionals before implementing complex financial strategies. If you found this guide helpful, hit that like button, share, and subscribe for more straight-talking financial advice that keeps you on the right side of the law.